Today, I want to explain an important investment concept, equity hedging. We'll start with a popular investment product called a buffered ETF, and then I'll show you how we implement a similar strategy using what we believe is a more effective and cost-efficient solution for our clients. Hello, and welcome back. I'm Robert Amato, Principal at Compass Wealth Management. Buffered ETFs are designed to help investors manage market risk. They use options to create a buffer against the first 10 or 20% of losses in the S&P 500 while still allowing for some upside participation. In other words, they aim to smooth out the ride when markets get rough. The trade-off is that these funds cap the upside. For example, a 20% downside protection ETF with a one-year term will typically cap gains anywhere from 8 to 10%, depending on where the options are pricing the day they put the strategy in place. And because they're structured as ETFs, they carry internal expenses, on average just shy of 1% a year. Now let's compare that to the customized structure we use for our clients. Instead of an ETF with ongoing internal expenses, we source institutional pricing with major banks through a competitive bidding process that allows us to eliminate internal fund expenses, commissions, and exit fees. Our structure also runs on a defined 2-year term. Here's how it works. It carries the same 20% downside buffer. It typically offers an upside cap of around 18 to 20%. We aim for 10% upside per year. And most importantly, it includes a unique feature. If the S&P 500 is down anywhere from -1 to -20% at the end of the term, investors still receive a positive return in proportion to the decline. For example, if the index finishes down 20%, the investment pays a positive 20% return. This is a key difference from buffered ETFs, which do not offer this feature. It also means our clients may have more capital available to take advantage of a discounted equity market. One of the key advantages of our approach is how we implement it within our broader risk management strategy. At Compass, we utilize our investment road signs framework to monitor market conditions. These road signs include things like labor market strength, Fed policy, interest rate trends, and equity valuations. When multiple signs suggest elevated risk, for example, when the market is trading at historically high valuations, that's when a structure like this becomes most valuable. It allows us to stay invested, but with a hedge in place. In other words, we can reduce risk exposure without stepping entirely to the sidelines or trying to time the market. At Compass Wealth Management, our focus is on helping clients participate in long-term market growth while proactively managing risk when conditions call for caution. That is the essence of equity hedging, and it's a critical part of how we work to preserve and grow wealth over time. Thank you for tuning in. Hi, I'm Robert Amato, Principal of Compass Wealth Management. If you found this video helpful, go ahead and give it a like, subscribe to our channel, and hit the bell icon so you don't miss future updates. If you're curious about how we help our clients get the most out of retirement, click the link in the description below to connect with us. Thank you.